I want to talk a little bit about how black money could be brought in or out of India using India's stock exchanges. This is coming out as part of the NSE colocation scam. And if you apply your mind to it a little bit, you'll understand what I'm trying to tell you. See, what you want to do is you want to make a legitimate looking operation and transfer money in the process. And what you also want to do is whenever you take black money out of India, you want to bring it back in as a white money. So one thing that we have told you was how people can use participatory notes. You use a hawala here in India, use that hawala to transfer, park 100 crores here. Maybe the hawala's equivalent sitting in Dubai gives you dollars worth of 85 crores. You take that 85 crores worth of dollars, go to Morgan Stanley or one of the big financial institutions and say that I want a participatory note for this amount, and they give you a participatory note. You take that participatory note and then you deposit in your company that you have created in Mauritius or some other tax havens which have a tax-free trade treaty with India. Now, then what happens is this Mauritius company will then use that money that is coming via the participatory note, invest it in the India Stock Exchange, and then when it say it will invest in a stock which is low in price, and then it will wait for that to go up, and then when it goes at a high price, it goes and sells that thing, so making a profit. Now, because the money came through Mauritius-based entity, the profits are not taxed. So this is one route. We have talked about this many times. So let's keep that thing at the back of our mind. So participatory notes are one way to make your black money go white. Another thing that now has come to light is the use of futures options. Options are those wherein I have to explain this to you in a technical way so that you understand, but mota I think you should be able to understand. So what are options? You have two types of options, calls and puts. Now, in call, what you do is you think that a particular stock, let's say, for example, Infosys, my favorite stock, Infosys is going to go up in value. Let's say today it is trading at 5,000. It is going to go up in value to 6,500 in 3 months' time. So what I do is today I can take an option and say that I am going to call, which means I'm going to buy if the Infosys stock goes up to 6,500 in 3 months' time. So what you think you know is that there is a big order coming Infosys' way, and because of that, they are going to have a big profit in this quarter. Therefore, the stocks are going to go up. And this you know because either you've done your research or whatever, right? So these are called options. Now, what happens is in options, the option you can opt to not exercise it. What that means is, let us say that it did not go up to 6,500. It went only to, say, 5,800. And you don't want to exercise the option. You can walk away. Whatever money you put in, of course, you will lose that. But the money you put in is not a very big amount. But if you happen to be making a call option when it is in the money, let us talk about an example of in the money call option. What it means is that I think that Infosys stock is going to go up. Let us say it is going to go up to, say, 6,500 by in 3 months' time. So what I do is that today it's at 5,000, and I think it will go to 6,500. Okay, and what I do is I call it as my strike price, and I say in 3 months' time, I think that Infosys stock is going to go up to 6,500. Now, the market is trading at 5,000. Let us say this 3 months, now I'm in July, so August, September, October. End of October is my option strike. So I'm saying that the end of October, the Infosys stock is going to go up to 6,500. Today it's at 5,000. Okay, comes August and this stock goes up to 7,500. My strike is at 6,500. This has gone up to 7,500. So today, if I exercise my option and sell and buy at 6,500, then I have an upside of 1,000 rupees per share. So that is what is called as in the money. That means that my strike price has already been covered by the option having gone up in the market. If such a thing happens, it's called as the in the money call option. In call, you buy. In put, you sell. So it's the reverse of this when you are talking about a put option, which is again 3 months down the road. So the key here is that using this call and put option, you can follow the market momentum and make quick money. Okay, this is in the money options. Now there are options which are called as out of the money. I'll give you the same example. Let us say that I think that Infosys 5,000 today, it's going to go up to 12,000 in October. Okay, now if you look at the history of Infosys, it probably never went up that high in this shorter time. Now what happens? This 12,000 is what is called as out of the money option. And when it is so far away, like more than double, it is called as deep out of the money option. Okay, so remember this, deep out of the money option. Now I'm going to show you a way in which some traders converted black money into white. And who they did it for, you know who has black money and how black money goes out of India through the Hawala agents. So let me show you an example of how this was done, because now the CBI investigation has stumbled upon this also as part of the NSE colocation. First thing that we have to remember, black money cannot be a round trip back into India as a foreign portfolio investment or a foreign institutional investment to book profit. This is illegal in India. If you can prove that the money went out of India through a Hawala into Dubai, and then that was used to come back into India as a foreign portfolio investment or a foreign institutional investment, that is illegal. This is how they need to catch this thing. So I've told you so if you have heard Dr. Swami's videos for last 10 years, he has been saying the same thing. There are 13 Hawala brokers. You catch them, throw them in the jail, make them cough up their books, and you know exactly who took, who sent how much money, who laundered how much money abroad. Unfortunately, even this government, which is 8 years into its term now, for one term, 5 years over, now it's the third year now going on, they still haven't touched these brokers. Okay, so that is the problem statement. You can fix this problem. It is possible. So how do these people do it? Remember I told you 5,000, 12,000. Which is called deep out of the money option. Deep out of the money option, right? What they do is using software, of course, because software has to be done. Software is key to run on the stock exchanges to try and hide a few things and to create a few things. What are the things that you need to create? You have to create trading links between National Stock Exchange, Bombay Stock Exchange, and the Commodities Exchange, MCX, to other global exchanges. These will be located in Dubai, London, Chicago, which is the Chicago Mercantile Exchange, that is for commodities, Singapore, and China, most likely Shanghai or Hong Kong. Why you need all these things? You need all these things because you need to create a pool of volume. A pool meaning like so many options, 100 option, 200, 1,000, 10,000, what have you. Options is not as commonly traded as, say, for example, shares. So these have to be created. So for this, again, you need some magic software. All right. So once the pool of volumes is created, then what happens is an out of the money call option, which is, remember, 5,000 going to 12,000 in 3 months' time is created. All right. Now, we know for sure by October, this will only go up to, say, maybe even very optimistically, it goes to 7,000. So 5,000 went to 7,000. You are sitting with a strike price of 12,000. So you have incurred 5,000 loss, because if you exercise at that strike price, you have incurred a loss of 5,000 rupees per share. Now, you book that as a loss. This is where the trickery comes. Supposing a broker is sitting on a 500 crore loss, and by making this out of the call option and by executing it, he incurs a loss of, say, 400 crores. He'll still pay no taxes, because whether it is 500 crores loss or 100 crores loss, he doesn't pay tax. but he has essentially made that 400 crores as a profit for somebody. Now, how do these games get played? First of all, when you create deep out of the pocket options, not many people are going to be interested. Why do I say that? See, a normal retail options trader like you and I, common person, will only look very close to the in the money options because they want to realistically make money, not lose money. Out of the market call options or put options are only done by people who have rock solid information about a certain event that is going to happen, or otherwise they're doing it to do some shenanigans, such as trying to book profits against a loss and then take that money out, and the black money has been brought in to India, and then the broker will give this thing to the person who gave him the original money in the first place. So let's say ex politician takes money from say a PWD contract or a kickback and gives it to a Hawala guy, and then the thing traces through the broker and the system and it comes back to him. 100 crores goes out, 400 crores comes in, and ergo the person has made 400 crores of black money coming back into India. This is a very, very effective deal because not many people will understand options. Derivatives are not very well understood. Even in the United States, these are not very well understood. So by just playing legit, by using some clever software, and by using different exchanges. By the way, it is not easy to trade from various exchanges. I'm giving you latency versus the setup cost. The setup cost is in lakhs per in lakhs. For example, I'll give you an example. The latency, that is, the time it takes for a order to travel from Dubai to Mumbai is 22 milliseconds or something, 26 milliseconds or something like that. And the setup cost is in the range of 18 lakhs. So this appears to be the best mode because you can relatively quickly take the order to the stock exchange to execute, and it also doesn't cost you very much. But sometimes what happens is you have to create the pool. So you have to go farther and farther to get the pool money in. So here are the numbers. If you are trying to do it from Singapore, if you're trying to execute a trade from Singapore, it will take you 52 milliseconds and it costs you about 22 lakhs. Likewise, from London, 109 milliseconds. From Chicago Mercantile Exchange, 200 milliseconds. Same from China. And the costs are also higher, mainly because it's American operations, so the salaries are higher, setup costs are higher, whatever it is. But you see how these companies have a branch in all these places. They will be making most of these trades through data servers based in India, so that SEBI or somebody who's looking at these transactions will only see the orders coming from an India-based server to the NSE, and the profit being booked and going back to the India-based server. It's a bit complicated, yes, but what has happened is if you do this thing day in and day out, and there is nobody looking at this stuff, then there is a lot of money to be made. And they have accidentally stumbled upon this, and now they are ready to, I think, make some moves in terms of like putting some people in jail. I expect companies like OPG would be right at the top of that list. There are a bunch of references that we are going to give that you can read to understand this in some more detail. What has been given is a bit cryptic. That's why I tried to use this particular monologue to help you understand how black money is being taken in or out of India. Thanks for watching. Please like, share, and subscribe to our channel. And also please click on the bell button for notifications. I realize the matter is a little bit heavy going, so I urge you to go and watch this more than once. And if you think that this was useful, help us keep our ink flowing. Thank you very much. Namaskar.